This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Too close to call, the factors the Federal Reserve weighs as it prepares to make what could be an historic decision on interest rates.
Your money, how higher interest rates may impact your long-term investments, from your bond holdings to CDs.
College calculus, is a degree really worth the price of admission? New data helps students answer that question. All that and more tonight on Nightly Business Report for Monday, September 14th.
Good evening, everyone, and welcome. I'm Sharon Epperson, in tonight for Sue Herrera.
And welcome from me as well. I'm Tyler Matheson. Is it really halfway through September? Well, finally, it's here, the week that investors across the globe have been waiting for, pointing to, worrying about for months. On Thursday, the Federal Reserve will announce its decision on interest rates, and possibly, just possibly, the central bank will hike rates for the first time in nearly a decade, taking what could be the first step away from an era of ultra-low interest rates, put in place, of course, during the financial crisis. But whether policymakers move is anything but certain. A month ago, many, if not most economists felt the Fed was positioned to hike rates. But that all changed as extreme volatility and uncertainty overseas bled into markets here. Now, just days before the meeting, many are calling it a toss-up. Hampton Pearson takes a look at the factors the Federal Reserve must weigh.
As the countdown to what could be an historic Federal Reserve meeting continues, the debate over whether monetary policymakers will raise rates for the first time in more than a decade has become too close to call. Economic turbulence in China in recent weeks and market volatility has jump-started the debate over the timing of liftoff.
By all the macro fundamental indicators, it's about time. And I think the debate really is more whether the turbulence in the last few weeks coming out of China, other parts of the world, affecting our own markets, is a reason to slow down on this.
Since the last Fed meeting, Janet Yellen and her fellow monetary policymakers will have data showing a rebound in economic growth, a solid job market averaging more than 200,000 new hires per month, with August headline unemployment down to 5.1%. In the next 2 days, policymakers will get new data on retail sales and the other half of the Fed's mandate, inflation.
I think they've made it clear they think of a lot of different things, but the most important things are what's the labor market conditions, which are getting much better, and then what's inflation. And inflation has stayed low, and if anything, looks like it's dropping.
Perhaps the biggest wild card is how markets react to the first reduction in monetary stimulus in nearly a decade, part of the balancing act for monetary policymakers because the markets and the Fed have become codependent. Two Washington wild cards for the Fed. A possible government shutdown at the end of September if Congress can't resolve budget disputes, and Treasury Secretary Jack Lew predicts a face-off with Congress in late October, early November over increasing the debt limit. For Nightly Business Report, I'm Hampton Pearson in Washington.
Whether a rate hike comes later this week, later this year, or even into next, it is coming, and there will be more after that. But the pace of the interest rate hikes is expected to be gradual, and the size of each rate hike expected to be small. So while the impact on your money may be limited in the short term, the same can't be said for the long-term effect. According to the most recent CNBC Fed survey, economists see the rate hike cycle ending in about 3 years, in the third quarter of 2018, with the Fed funds rate reaching 2.79%. The current Fed funds rate target rate is near zero. And there are steps you may want to consider taking right now to prepare for higher borrowing costs down the road. If the full thrust of the rate hike debate has you wondering what to do with your investments, you're probably not alone. Yes, a changing interest rate environment can cause violent swings in the stock market. Those ups and downs, though, as dramatic as they may be, are a good reason to keep an eye on your asset mix. Rather than worrying about where the stock market will be next week or next month, stay focused on your longer-term investment goals. With rates near zero, a quarter-point rise won't likely have a major impact on your day-to-day life. The interest your bank is paying on a savings account still won't make you smile. But if rates continue to rise, say 7 or 8 times in 3 or 4 years, you will begin to notice. When it comes to the cash portion of your investment portfolio, as rates begin to climb, consider laddering or overlapping the expiration dates on CDs. Laddering allows you to step up to a higher rate each time a CD expires. As for bonds, short-term bonds and bond funds may be safer if the Fed is raising its lending rates. Expect bond yields to climb, which means prices will drop. If you're in a longer-term bond or bond fund with mostly 10-year or 30-year bonds, you'll have to stand by as the value of that bond drops. If you're in shorter-term bonds, you'll limit the time your investment is exposed to a falling bond price, while also getting the benefit of a rising yield. Retirement savers, look under the hood. Bond funds are a big part of target date funds in many 401k plans. As you get older, your plan tends to put more of your assets into fixed income, so check on what type of bond funds are in your plan. Mortgages will also be impacted by rising rates, so if you're determined to get the lowest possible rate, think about taking action before the Fed, but don't worry. 30-year mortgage rates have been hovering at or below 4% on average this September. Rates were double that 15 years ago. And that's a level we're not likely to see anytime soon.
Here with some more perspectives on what to do with your money when rates do begin to rise is Mark Cortes. He's a senior partner at Macro Consulting Group. I don't know whether you agree with what Sharon just said or you disagree. I'm not inviting you to contradict her. But when rates do rise, is it necessary, whether it's this week or this year or next, is it necessarily a time to do anything?
Well, rates rising, people are using as a general statement, and we think that there's two different aspects of rates rising. We have short-term rates that we do believe will rise in the short to intermediate term. But the impact on longer-term rates, sometimes when you see interest rates rise on the short term, they take some future growth out of the economy, and you can see longer-term rates actually come down a bit, and you see a flattening of the yield curve. So depending on why you own bonds, if you are an accumulator and you have bonds to stabilize your portfolio in times of volatility, I think that you stick with short to intermediate term paper, high quality, things that do hold up well in an environment like that when equities are doing poorly. But if you're a long-term, if you're a retiree looking to invest for income, I think that if you have individual bonds, you hold them to maturity, if you have short-term fluctuations of the value, it's not as big of a concern if you know at maturity you're going to get your principal back.
If you're a longer-term investor, there are some firms out there that are saying we are going to reduce our fixed income portfolio just a little bit. Some saying that maybe instead of 75% bond or 65% bond of fixed income, or I should say 35% fixed income, 65% stocks, we're going to reduce that to under 30% for bonds. Would you say that reducing fixed income by 4 or 5% makes sense, adding that to the equity portion of the portfolio?
Well, cash is earning close to zero or at zero. And so by reducing that exposure, you are giving up volatility to your principal. You're also giving up all of your yield. So you better be right that interest rates are going to rise on short-term cash instruments in order for that to weigh in your favor. If you have a laddered bond portfolio or you have a portfolio that has shorter-term fixed income instruments in there, every year as those bonds come due, if rates are rising, you're reinvesting into those new higher rates. So if you don't need the money, if you need the money in a year or 24 months from now, I would stick with cash and shorter term instruments. If this is part of a portfolio that is there to generate income and be a buffer for the volatility in the equity piece of your portfolio, if you're in accumulation, I think I would act differently and invest a little bit differently than if you're drawing income. If
rates rise at a moderate pace,
yes,
what will the effect be on my equity portfolio?
Well, we run a dividend portfolio that the yield on it's about 1% higher than what you're getting on a 10-year Treasury. And we've positioned some of the components in there with companies that do benefit from rising interest rates, companies that have a lot of short-term instruments.
Like what?
Like paychecks. They take the money from the employer, they hold it for days before they actually cut checks and pay. So they make, when rates were at 3, 4, 5%, they were making a lot of money on that float. So those are companies that, if short-term rates rise, that increased income that they're getting on that cash is riskless. It drops right to the bottom line. That can improve their profitability, improve their dividend yield.
Generally, are you looking then at smaller cap, mid cap, as opposed to larger cap as you look into this?
We like larger and mid cap stocks and things that have good, consistent cash flow. Companies that are subscription based or that have reusable consumers, because as they're getting new cash in, if rates are rising, when they get that new cash, they can deploy that into those higher interest rates.
Mark, thank you very much. Very helpful advice. Appreciate it. Mark Cortes with Macro Consulting Group.
Stocks declined to start the week as investors remained in a wait-and-see mode ahead of the Federal Reserve two-day meeting and were hesitant to take any big positions ahead of this decision. The Dow Jones Industrial Average fell 62 points to 16,370. The blue chip index traded in the narrowest range since mid-August. The Nasdaq dropped 16 points and the S&P 500 declined 8.
The Organization of Petroleum Exporting Countries cut its forecast for U.S. oil production and predicted higher demand for its crude next year. In its monthly report, the oil cartel said U.S. oil producers were beginning to feel the squeeze of lower oil prices and would in turn cut production and the global surplus. A weaker than expected economic data out of China also pressured crude today. It settled down almost 1.5% to $44 even per barrel.
There is one industry that is highly dependent on the oil market, and that's the crude tanker industry, because all that crude has to be shipped and hauled across the globe. And this coming quarter could be especially strong for this sector. Morgan Brennan explains.
With the world awash in oil and prices again under $50 a barrel, there's one market that's benefited: crude tanker ships. In the first half of 2015, rates for very large crude carriers that carry up to 2 million barrels per trip peaked at $90,000 a day, for some ships hauling oil to Asia. But by August, rates had plunged 70% as demand slowed down ahead of refinery maintenance season. Still, analysts say this sector is poised for its best fourth quarter in years.
We do think that the tanker market is going to see more upside as we move into the fourth quarter of this year. Seasonally, see stronger demand from both a heating perspective and an overall energy consumption perspective in the fourth quarter. And we would expect to see, from a supply perspective, not a lot of incremental deliveries to the existing fleets.
Shipping rates are already rebounding, up nearly 50% from their August low. The demand is coming from Asia, where China is expected to build up crude reserves despite a slowing economy, to take advantage of higher refining margins. With low fuel costs a tailwind for earnings, and only a limited number of new ships coming online through next year, all of this could bode well for stocks like Euronav, Nordic American Tankers, and DHT Holdings. Small cap names, but ones that represent pure plays in this market. TK Tankers, Frontline, and Tacos Energy Navigation could also benefit, since all have crude tankers in their fleets as well.
Yeah, within the sector, we have buy ratings on two key players that are very well exposed to this trend. The first is Euronav, which is our top pick in the space. The second is Generate Maritime. We also have a buy there. Both of these companies have significant spot exposure to the very largest of the crude carriers that move crude around the world globally.
Another potential positive: if sanctions on Iran are lifted, that could add an estimated 500 to 700,000 barrels of oil daily to the global supply, pressuring prices and further boosting demand for these massive ships that haul crude across the high seas. For a Nightly Business Report, I'm Morgan Brennan.
And if you've noticed a substantial drop in gasoline prices, you are not seeing things. According to the Lundberg survey, the average price of a gallon of regular gasoline fell 27 cents in the past 3 weeks, now sits at $2.44 a gallon, more than $1 below where prices were a year ago. And AAA reports that gas prices have fallen below $2 a gallon in 3 states: South Carolina, Mississippi, and Alabama.
Still ahead, go to college, get a good paying job, pay off your loans. That's easier said than done, until now. New data that can help you determine the potential return on your college investment.
New York's top banking regulator reached an agreement with 4 major banks over their chat systems. The focus is on a new messaging platform called Symphony Communications that regulators worry could be an obstacle when they try to conduct an investigation. As part of the settlement, Symphony will retain copies of all their chats. The agreement was reached with Goldman Sachs, Deutsche Bank, Credit Suisse, and Bank of New York Mellon.
The Labor Department contract for more than 140,000 auto workers expires at midnight. Negotiators for the United Auto Workers have chosen Fiat Chrysler as their so-called target company. That means the union will craft the first of 3 agreements with Fiat Chrysler. Similar deals are expected to follow with Ford and General Motors. The negotiations are focused on health care and wages, and the talks come as auto sales sit at near record levels.
Europe's largest plane maker, Airbus, has officially started building commercial jets in Alabama. It's a big move that will help Airbus strengthen its position in the U.S. market while adding even more manufacturing jobs down in the southeast. Phil LeBeau reports tonight from Mobile, Alabama.
They may be European, but Airbus executives understand the appeal of Sweet Home, Alabama.
But, you and your colleagues are now a part of Airbus.
This plant in Mobile will eventually build 48 A320s a year. Almost all will be flown by airlines in North America, where Airbus trails Boeing.
We want to be a global player. And we cannot be a global player without a strong industrial footprint in the biggest market, America. We did it in China a few years ago. It was a great success. So this is exactly what you see behind me, becoming global.
As Airbus expands outside of Europe, lowering costs is a central goal. Just as Boeing added a plant in South Carolina that employs non-union workers, Airbus is following a similar strategy in Alabama, where the plant will eventually hire at least 1,000 people who won't be in a union.
It gives you such an advantage to be able to work without a union, to feel like a union is not even needed, because it's the way Airbus treats you. The Airbus treats you right. There's no need for it.
We're getting put on the spot. I mean, little Alabama, we're having a big old facility come here, so I mean, to me it's just awesome.
The first A320 will fly out of this plant next spring, with full production scheduled by the end of 2017. And if there's enough demand for newer, more fuel-efficient aircraft, Airbus says there's room to expand this plant. Phil LeBeau, Nightly Business Report, Mobile, Alabama.
Investors cheer good phone news from Apple, and that's where we begin tonight's Market Focus. The tech giant announcing that sales of its new iPhone 6s and 6s Plus are on track to beat last year's first weekend record sales. The company took pre-orders for the phone starting Saturday. The phones will go on sale September 25th. Shares of the Dow component rose almost 1% to 115.31. A report from Barron's weighed on shares of Alibaba today. The publication said the company's stock could plunge 50% from current levels, and it questioned the accuracy of some of the claims Alibaba has made about its user count and shopper spending. Alibaba responded in a statement saying, "We take strong issue with the reporting about the state of our company and feel compelled to set the record straight." The company went on to defend itself against the allegations. Shares tumbled 3% to 62.60. And shares of Yandex, which is Russia's version of Google, rose today. This as Russian authorities ruled that Google was abusing its market position in the country and would face penalties. Yandex saw its stock pop almost 7% to $12.05.
Shares of Raptor Pharmaceuticals went the other way after the firm announced it will stop developing its liver drug. This as the treatment failed to meet the main goal in a mid-stage study. Shares there down a whopping 37%. They settled at $7.52. Solera Holdings, which is a provider of tech services to insurance firms, will be acquired by an affiliate of Vista Equity Partners. The deal valued at about $6.5 billion. Shares up 8.5% there to $53.66. And Twitter has partnered up with the payment processing company Stripe. The move will let retailers sell on Twitter. Customers will merely have to click on a buy button on the site. Twitter shares slipped, though, nearly 2% to $26.90.
The federal government released new data over the weekend that revealed the earnings of people who attended nearly every college and university in the country. The database is designed to help students compare tuition costs with potential earnings. Beth Akers is a fellow in the Center on Children and Families at the Brookings Institution, and she joined us now. And Beth, I have to tell you that right now I have bookmarked this website because there's so much information that I think that every parent who has children and anyone who's interested in what college may cost and what potentially students can earn should have this website and be looking at this federal government information. What do you make of it?
You know, absolutely. This is a tremendous innovation when it comes to higher ed policy, and from the consumer's perspective, their ability to shop for college. Historically, we've had students going in and making this decision about college with very little information, And for the first time, they can really see what it is they're buying by looking at how students who have gone to an institution before them have fared when it comes to earnings and their success in repaying their loans. They can have a really reasonable expectation about how they could themselves expect to do after they finish their degree, and it's incredibly important.
What the government did was look at people who have outstanding student loans and then looked from 2000, 2001 or 2001 and 2 and looked at what the median pay of those men and women was 10 years down the pike. It's a big range of numbers, but I'll tell you one thing, Beth, that stood out to me was how disparate the numbers were, no matter what the educational institution was, between what males earned and what women earned. In many cases, it was way more than the usual sort of women earn 75% of what men do. It was a broader gap than that.
Yeah, absolutely. So the data that presented in this data set are consistent with what we generally knew before, which was that there's the existence of this wage-gender gap. Unfortunately, we don't exactly know why, and we've had this data set available for about 48 hours now, so us researchers are sort of grinding away trying to get some answers, but I think there'll be a lot to come.
When you look at 10 years out, what folks are earning, what was also very interesting, when you go to this collegescorecard.ed.gov, you can find out what they're doing in terms of for-profit institutions versus public and private institutions, where the annual cost comes in, and then what the earnings are. And what was interesting was that the earnings actually 10 years out aren't necessarily that high when you're looking at some of these for-profit colleges. You actually see those numbers right there comparing the cost to other types of schools. Do you think this is how families, students, and parents will be using this information going forward?
I absolutely hope so. I think, what you identified with the trend with the for-profits is one of the things that came out in the early analysis of this data. But what I would recommend to households who are making decisions about college is you look at the options that you're thinking of going to, and you really want to do some sort of cost-benefit analysis for yourself. I mean, the reality for most households is that they're sending themselves or their children to college to improve their financial circumstances, and now they have the data to do that.
Tell me a little bit about surprises as you saw them. I thought that there was no surprise at the colleges that seemed to produce the highest earnings. They were the Harvards, the Stanfords, the MITs across the board. But what were the surprises in there, high and low?
Right. So as you said, we'd expect there to be a lot of variation in outcome across institutions. The most elite schools are likely to have the best outcomes, and that's not a surprise. So I think what we just talked about, the for-profit institutions, is really where we've seen the biggest surprise in the trends in the data. And what we're seeing is that individuals—
They weren't worth it, or they were worth it?
In fact, they weren't worth it, or at least the students who we see going to those schools, who are the non-traditional students, or lower income students, more likely to be financially independent and older, they're really just facing bad outcomes. And those are the ones who are most likely to be at the for-profits and the community colleges. So the question is still open, why is that the case? But it clearly points the spotlight on this as something that policymakers need to be thinking very carefully about.
Yes, Beth, a lot of great information on that website for parents and for families, for students. I thank you so much for breaking it down with us. Beth Akers with the Brookings Institution.
And coming up, eye in the sky, Northrop Grumman's plan to keep growing even as defense budgets shrink. Here's what to watch tomorrow. Important reads on the economy, including retail sales, also a measure of industrial production. The Fed watches that one big time. And a report on business inventories. That, folks, what to watch Tuesday.
And Tyler, two of the biggest names in the defense industry want to dominate the sky, but they have very different visions about how to go about doing it. And as Jane Wells explains, it's intensifying an already powerful rivalry.
There's a political dogfight for dollars in shrinking defense budgets between manned versus unmanned aircraft, pitting the Lockheed Martin U-2, a manned spy plane which has been flying for 60 years, against the Northrop Grumman Global Hawk, unmanned and a huge part of 21st century surveillance. Northrop hopes to win.
So the average sortie right now is in excess of 28 hours, and we've had flights upwards of 32 hours.
2 years ago, the Pentagon wanted to kill the Global Hawk to save money, even though it had 95% of its lifespan remaining. Northrop lobbied hard and won the opportunity to now test new sensors which could allow it to replace Lockheed's U-2, pitching the idea that the unmanned aircraft could fly longer and safer without a pilot on board. Northrop's Mick Jagger says the U2 sensors and cameras can just be bolted right onto the Global Hawk.
It gives you now that ability to plug and talk to new sensors.
At the same time, the real growth in UAVs is on the commercial side, but the Global Hawk is too expensive and complex to make deliveries for Amazon, so Northrop is trying to find new markets. Jagger suggests maybe using some of the unclassified technology inside the Global Hawk to perhaps replace one pilot on board long-range cargo commercial flights. If Northrop pulls this off and succeeds, it will be a dramatic turnaround for a program which 2 years ago was supposed to be shot down.
Since that point in time, we've resurrected the system, and we're now flying more hours in FY15 than we flew in all of FY13.
Testing of the new sensors, including some used on the U-2, will begin on the Global Hawk shortly. But Lockheed isn't giving up on its U-2, and it will be tough to win over work from a workhorse which has been doing the job for half a century and is already paid for. For Nightly Business Report, Jane Wells, Los Angeles.
And finally tonight, Forbes is out with its list of the most valuable teams in the National Football Leagues, and the numbers are eye-popping. The third most valuable team, my hometown favorite, the Washington Redskins, team valued at $2.8 billion. Number two, the New England Patriots, valued at $3.2 billion and inflating. And topping the list are the Dallas Cowboys for the 9th year in a row. That team is worth $4 billion, most valuable sports franchise, folks, in the world, stripping Real Madrid of that title, Sharon.
Wow.
And the Cowboys won last night.
Yeah, go figure. That's Nightly Business Report for tonight. I'm Sharon Epperson. Thanks so much for watching.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we will see you tomorrow night.